Hello and welcome to Financial Intelligence. In this video, I want to summarize the tax benefits of opening an HSA account. Health savings accounts, or HSAs for short, are unique in a sense that they offer triple tax advantages. HSAs can be a smart choice for taking care of medical expenses today and saving for payment of unreimbursed healthcare expenses in the future. Investors shouldn't overlook HSA's role as vehicles to save for medical expenses in retirement, especially considering the fact that healthcare expenses generally rise. Health savings accounts are generally thought of as a tax shelter. There is no other vehicle under the tax code that has the kind of preferential treatment that health savings accounts have. In this video, I want to cover the three types of tax savings offered by HSAs. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. A quick intro to HSAs before we get into their tax benefits. Health savings accounts, or HSAs, are used to pay healthcare expenses. Eligibility is restricted to those with a high deductible health insurance plan who are not enrolled in Medicare. A high deductible health insurance plan, as the name implies, is a plan with a higher deductible than a traditional insurance plan. What this means is that the monthly premium is usually lower, but you pay more healthcare costs yourself before the insurance company starts to pay its share. Because of the significant tax advantages of an HSA, the IRS has put a limit on how much someone can contribute to an HSA each year. For the tax year of 2021, the maximum contribution limit is $3,600 for an individual and $7,200 for a family. Those account holders 55 and older can contribute an additional $1,000 annually. You must use funds in your HSA on qualified medical expenses, or penalties will apply. Qualifying costs are those you typically incur to treat or prevent a physical or mental defect or illness, including any vision and dental care. Now let's focus on the tax benefits of these accounts. Benefit number one, pre-tax contributions. One of the best perks of an HSA is that when you make a contribution, you are adding money tax-free. Most employers offer an HSA, which means that you can contribute to your HSA account through a pre-tax payroll deduction. In other words, by using payroll deduction to fund the HSA, every dollar you contribute from your paycheck is a tax-free dollar added to your HSA. If you are not sure, talk to your employer to find out whether your company provides an HSA. If your employer does not provide an HSA, you can open an account yourself. You can make contributions to your HSA, but you need to make sure that you are covered by an HSA qualified health plan, which, as I mentioned earlier, is a high deductible health plan. In this case, after making your contributions, you need to claim those contributions as tax deductions when you are filing your taxes so that they're not counted as income. If you are self-employed, you contribute pre-tax and it won't count toward your taxable income. Benefit number two, tax-free earnings. If you plan to use the account to pay for everyday health expenses in the short term, you may want to keep the funds in cash. However, if you're saving for future medical costs, investing a portion of your HSA may provide you with the potential for tax-free growth. Any investment earnings in your HSA account grow tax-free, including dividends, interest, and capital growth. HSAs earn interest just like a traditional savings account. But unlike a traditional savings account, interest earned on an HSA account is not taxed. Once an account meets a certain balance threshold, funds can also be invested in mutual funds or stocks to maximize HSA earning potential. As a side note for folks who aren't familiar with dividends, dividends are payments made by publicly listed companies as a reward to investors for putting their money into the venture. If your HSA investments pay dividends, those earnings are going to be tax-free as well. Benefit number 3, tax-free withdrawals. An HSA enables you to make tax-free payments for qualified medical expenses, including some that are not typically covered by insurance or Medicare. This means that you pay no taxes on the amounts withdrawn to pay for the qualified medical expenses. These include nursing home care, premiums for long-term care insurance, prescription drugs, vision care, and more. Therefore, all the capital gains from your investments in your HSA account are tax exempt. This is unlike other types of retirement plans such as 401k accounts, where all gains will be taxed at the time of withdrawal. As mentioned before, the only caveat is that account holders cannot use their HSA funds to pay for, say, vacation or buy a new big screen TV. They can only fund doctor's visits, dental and vision care, and similar expenses. Spending HSA funds on non-qualified medical expenses results in taxes and an additional 20% penalty. I hope that you like this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to subscribe, like this video, and hit the notification bell so that you won't miss any of my future videos. Thank you and take care.